let's get another perspective on where the economy and the Fed might be headed. Joining us now, we've got Blerina Uruci, who is the Rowe Price Chief U.S. Economist. Great to have you here with us this morning. You were just hearing what we're looking out for this week, and of course, you've got your eyes set on that too, but perhaps looking further even out into the future here. What is kind of this policy pathway that you would anticipate and perhaps base some of your own expectations for what the Fed may do around?
Thank you for having me. Yes, I agree with Alexandra that we're in for a strong GDP report for Q4, and that's going to be driven by the U.S. consumer. The U.S. consumer has surprised everybody in 2022, and I think a large part of that story was the strength in the labor market. We had very robust employment growth last year, and aggregate incomes increased. I think this mattered more than average earning measures, because what matters for the consumer is the total amount of income that they're getting every month. And I think that was pretty strong last year, but that's due to decelerate significantly this year, as I expect employment growth to come down a lot from that 300 to 400 pace of job growth in 2022. I think that slows closer to 100K employment growth for this year. So as I look into the outlook for the U.S. economy this year, I think a recession is not imminent because the momentum in the labor market is still holding up pretty strong. But I think a recession is more likely than not in the second half of the year. So the U.S. economy slides into a recession because we lose this strength in consumer spending. I'm pretty pessimistic about spending on goods in the first half of the year, but I think that's going to be balanced out by services spending. However, as we enter the second half of 2023, that's also going to slow significantly. So this is how I'm looking at the outlook for the U.S. economy for this year.
And what is all of that going to mean for inflation? Because we've been talking to some economists and investors who say maybe inflation is still going to be a little bit more persistent than we are bargaining for. What do you think?
Well, I think a lot will depend on what happens on the services side of the economy. But to use the layers of inflation analogy that Chair Powell has been discussing a lot the last few months, we're having a significant and meaningful deceleration in core goods inflation. I think that's going to continue for the rest of this year, because I think predominantly inflation last year was a strong demand story, and that's going away from us in terms of demand for goods. And I think there's going to be some tailwinds there from the improvement in supply chains and the improvement in transportation costs globally, as well as the strength of the dollar last year. That tends to have very long lags as it pertains to inflation. And then I feel that the shelter component of inflation is going to slow significantly in the second half of the year. If you look at private sector measures of rent, they tend to have a 9 to 12 month lag with respect to the BLS measure, which we know is very sticky and has a lot of inertia. But I think that turns in the second half of the year. And then the services, excluding shelter, may remain sticky. But I think as far as the Fed is concerned, if the average of these three pillars is trending toward 2%, that should be enough to give them peace of mind to decelerate the pace of hikes and then to eventually pause in Q2 of this year.
Blerina, on the topic of the consumer, from what we've heard from some of the banks who have already reported their earnings for, of course, the most recent quarter, but always looking out into the future as well, they've called the consumer healthy, called the consumer resilient. But for a consumer that's also looking across headlines of layoffs and trying to monitor the unemployment situation as well and maintain their own income and combat inflation at a household level, what do you believe the real vibe of the consumer is right now, perhaps?
I think this is a great question because, of course, we're all looking at the aggregate data for the U.S. consumer, and the balance sheet remains healthy. Consumer credit card borrowing has increased, but it remains still within a healthy range that the U.S. consumer has been able to sustain for many months before the pandemic. So I think those aggregate measures tell us not to worry yet. But of course, I think we are underestimating the fact that there was a lot of underlying strength to the U.S. consumer demand last year because jobs were so plentiful. I think, though, when we look at a range of labor market indicators, demand for labor and vacancies, they're coming down. And I think eventually this will feed into consumer confidence and willingness to spend. There's, of course, the excess savings story. I think that was a big support to spending last year. We know that those excess savings are being depleted. And for lower brackets of the U.S. income distribution, they may have already been depleted. But I do think that those savings could quickly turn into precautionary savings, and consumers could turn more cautious as well as soon as the labor market turns.
Blerina Uruci, Rowe Price Chief U.S. Economist. Good to see you. We'll talk to you soon.